Welcome to Global Markets Daily Brief. I am Jonathan Simkovitz. It is Wednesday, February 25th, 2026. A Substack post moved the market $800 billion on Monday. Not a Federal Reserve statement, not an earnings miss, not a geopolitical event. A thought experiment, published on a Sunday by a 33-year-old research writer, sent the Dow down over 800 points in a single session. DoorDash fell more than 8%. IBM dropped 13%. Blackstone, American Express, KKR, Visa, MasterCard all down 3 to 8% in a day. The iShares software ETF hit a new 52-week low and erased every gain since the launch of ChatGPT in late 2022. The obvious question is whether the Citrini thesis is right. But the more useful capital allocation question is different. Why was a self-described scenario exercise, one that its own authors explicitly called neither a prediction nor doomer fiction, capable of triggering that magnitude of selling? The answer has very little to do with the report's content and almost everything to do with the positioning underneath this market. Here is what happened. On Sunday, February 22nd, Citrini Research published a piece titled The 2028 Global Intelligence Crisis. It was written as a fictional dispatch from June 2028, imagining a world where rapid AI adoption triggers mass white-collar unemployment, collapses consumer spending, and sends the S&P 500 down 38% from a hypothetical October 2026 peak. The piece introduced concepts like ghost GDP, the idea that machine-generated output shows up in national accounts but never circulates through the household economy. Michael Burry amplified it on X with the line, "And you think I'm bearish?" The post racked up roughly 16 million views. On Monday, the sell-off was immediate and broad. The Dow lost 822 points, down 1.66%. The S&P 500 shed 1.04% to close at 6838, putting the index back in the red for 2026. The Nasdaq fell 1.13%. Breadth was brutal. Only 27% of stocks gained ground on the day. Financials were the worst-performing S&P sector, down nearly 3%. The Russell 2000 dropped nearly 2%, outpacing losses in large caps. By Tuesday, the recovery began. Anthropic held a previously scheduled event positioning its Claude tool as an integration layer that partners with existing enterprise software, not a replacement for it. Salesforce and ServiceNow bounced more than 4% and 2% respectively. The S&P 500 recovered roughly 0.8%. Today, Wednesday, the S&P is up another 7 to 0.8%, with the Nasdaq leading, up over 1% ahead of Nvidia earnings after the close. That is the first-order reaction. Let's step back. The consensus view of what happened Monday is that a viral bearish note spooked a nervous market. That framing is accurate as far as it goes, but it misses the structural story underneath the price action. And the structural story is what matters for positioning over the next 1 to 4 weeks. Here is what consensus believes. The Citrini report scared retail investors and momentum traders into selling AI-exposed names. The Tuesday and Wednesday bounce proves it was an overreaction. Software is now a buy-the-dip opportunity. The broader market remains fundamentally healthy. Nvidia earnings tonight will settle the narrative. Here is what that framing misses. A speculative essay does not move hundreds of billions of dollars in market capitalization unless the market is already pre-positioned for that kind of move. The Citrini report was a catalyst. It was not the cause. The cause is a positioning problem that has been building for months. Think about the context. Software stocks, as measured by the iShares Expanded Tech Software ETF, had already lost roughly $1.2 trillion in market value through February before the Citrini post was published. Microsoft had already fallen 13% earlier this month after an earnings report that failed to justify massive AI capital expenditure with corresponding revenue growth. IBM was already fragile. Oracle is down down 25% this year. The software sector was not sitting at equilibrium, it was sitting on a ledge. The Citrini piece was the nudge. This is important for understanding what is actually being repriced. The market is not repricing AI capability. No one serious disputes that AI is getting more powerful. What the market is repricing is the distribution of AI's economic value. The old narrative was simple. AI makes companies more productive, margins expand, earnings grow, multiples are justified. The newer and more uncomfortable narrative, which Citrini articulated vividly but did not invent, asks a harder question. If AI makes companies more productive by eliminating the workers who are also the customers, where does the demand come from? That's not a new question. Economist Claudia Sahm made this point on Monday, noting the focus on destruction rather than construction. The answer probably involves both, but the market has been pricing only the constructive half. Here is what is priced in. The market has largely absorbed the idea that AI will boost productivity and margins for companies that adopt it well. That's reflected in the massive capital expenditure plans from the Magnificent Seven, projected to spend over $650 billion on AI infrastructure this year alone. Here is what is not fully priced in: the second-order effects on seat-based software licensing. If AI allows one developer or one analyst to do the work of 5, companies don't need 5 software licenses. They need 1. That's a structural headwind for every company whose revenue model depends on per-user pricing. The sell-off in software names is not irrational. It's the market beginning to grapple with a real revenue model problem. What is also not priced in is the speed at which the narrative can shift. Monday's selling was concentrated in names specifically mentioned in the Citrini report, including DoorDash, ServiceNow, Visa, and MasterCard. That specificity tells you something. It tells you that positioning in these names was crowded enough that a scenario exercise could trigger forced selling. That's not a sign of a healthy market structure. That's a sign of fragile positioning. There's one more thing not priced in. The macro backdrop is weaker than the headline index levels. Q4 GDP came in at 1.4%, well below expectations. Core inflation is running above forecast. The Federal Reserve is in no hurry to cut, with Governor Waller this week describing the March rate decision as a coin flip. Bitcoin has crashed from above 126,000 in October to below 63,000, its worst month since 2022. Private credit stress is emerging, with Blue Owl halting withdrawals. The Citrini scenario draws a line from AI disruption through white-collar defaults into private credit and housing. You don't have to believe the full chain to recognize that several of its early links are already visible. My base case is this: the Citrini sell-off and recovery are not the story. The story is that the market revealed how thinly supported the current consensus really is. Positioning in AI beneficiaries, software, payments, and financial intermediaries has been long, crowded, and increasingly divorced from near-term earnings validation. Any catalyst that challenges the narrative of frictionless AI-driven margin expansion can produce outsized moves. That fragility doesn't disappear because the S&P bounced on Tuesday and Wednesday. Consider 3 scenarios over the next 1 to 4 weeks. The base case, roughly 55% probability, is that Nvidia delivers a strong earnings report tonight. The market interprets this as confirmation that AI infrastructure spending remains robust. Software names stabilize but do not reclaim February highs. The rotation from application layer software towards hardware and infrastructure names continues at a moderate pace. The S&P trades in a range between 6,800 and 7,100. Volatility compresses slightly from Monday's spike but stays elevated relative to January. This is the orderly digestion scenario. The bull case, roughly 20% probability, is that Nvidia's results and guidance are strong enough to reignite broad risk appetite. More importantly, the earnings commentary directly addresses the demand question, providing evidence that enterprise AI spending is creating new revenue streams, not just destroying old ones. Software names begin to differentiate, with companies that have credible AI integration stories separating from those that are pure seat-based probability-based models. The market broadens. Small caps participate. The S&P pushes towards 7,200 by mid-March. The bear case, roughly 25% probability, is that Nvidia disappoints on guidance, or, more likely, delivers results that are strong but fail to justify current multiple expectations. In a market where positioning is fragile and the narrative is contested, a soft Nvidia print could accelerate the rotation already underway. Software losses deepen. Private credit concerns resurface. The S&P 500 tests the 6,700 level, its February low. I would assign a slightly higher weight to the bear case than normal, not because the Citrini scenario is likely to play out in full, but because the positioning dynamics it exposed are real. Markets that sell off $800 billion on a Substack post are markets with embedded fragility. That